to yet another episode of the London Eye. My guest today is Prashant Periwal, who manages the Asia book and is director at the hedge fund called ALTIMA Partners. Prashant, very good to speak to you. We've had a great rally since the end of February. But at this point, given where prices have reached, are you still feeling optimistic, or do you think it's time to take a little bit of froth off the table?
Well, yeah, let me answer it in a different way, that, what led us to this position from Feb. So we had, commodity prices rallying higher, oil going up about $20, we are at 50 now. China unleashing another yet large stimulus to put some sort of a floor on the economy. And then we had massive rallies on the back of that in all the emerging markets. So from here on, do I expect oil to go up another $20 from here? No. Can China continue its credit binge? Probably, but it's not good. And that leads you to believe that, so the rally has been very sharp, but then probably here's a time, we take some bit of a breather, consolidate here.
What's the biggest risk you see going into this summer? Is it the fact that valuations have expanded quite considerably, given that earnings are still not very strong? Or do you see events posing a risk, like Brexit or the US raising rates, something coming from those fronts?
Yeah, it's always, I guess, a mix of a lot of things. So macro events are what they are, whether it's a Fed rate hike or Brexit, etc. But I think, on the other hand, we could have, issues emerging out of China, and, starting from their sort of the currency to, overall economy, etc. So, and then on the top of it, valuation. So, a culmination of all these three factors could be a bit of a bigger problem. But then, yeah, of course, valuations are not supportive, but that's like for the market overall. Not to say that bottom-up opportunities do not exist, they do, but one has to be selective, is probably, I would put it in that way.
How do you characterize this rally? You explained the reasons behind it, but would you say it's, in the overall context of where the market is, a powerful relief rally or a rally, or do you think, as some people are characterizing it, as a start of something more meaningful, like a sustainable uptrend for many months or quarters?
It's difficult to sort of predict, what happens in the next, say, 2 or 3 months. But overall, we are supportive of emerging markets in general. We have gone up a bit too fast. If you talk about India, we've had strong, numbers for Q4 FY16. In 1Q, data points are very supportive. Call it all these leading indicators, cement production or power production, etc. Everything seems to be taking a breather as of now. I think we need to see whether the earning growth pans out, and that is basically help us going to answer whether it's going to be a sustainable rally here, or we'll go back into the shell again.
What's your gut feeling? Do you think this is the quarter where earnings have turned a corner, or you need to see more evidence to conclude?
I think we definitely need to see more evidence. Look, on one hand, if we strip out banks within India, earnings have surpassed expectations, but then not to say that, we have turned the corner here. With respect to banks, I think, what the challenges could be, we can always say, look, the worst is over, but do we really know that? We could have said worst is over 2 years ago with some of these banks, but it just, keeps coming. So yeah, sustainable for sustainable sort of a reward from here, we need to see more evidence.
You spoke about banks, and you do have positions in banks in the Indian market. How do you position yourself in that sector, given that public sector banks reporting mess after mess, but their valuations technically look appealing? On the private sector front, you've got numbers which are better, but in many cases valuations are very lofty. What's the middle line there?
Well, it's an interesting one. Look, in public sector banks, one is a reported price to book, and one is the adjusted book value. So if I was to take out, adjust for the NPS, which are not provided for, some banks are basically zero equity. So what's the book value there? And what's price to book there? So it's very difficult, it's sort of infinite. But with respect to private banks, you have to pay for quality in this market, and all you need is basically a bank where you can see a sustainable book value accretion. So you want to be sort of, positioning yourself into a retail-oriented bank. Though it may sound very boring, why buy banks at 3 times, 4 times price to book? But then, if that is the bank that is offering you a sustainable growth, the answer is why not? If you look at, forget like last 2 years. If you look at last 5 years, point to point, 10 years, point to point, even 15 years, point to point, and we can compare the returns that the so-called expensive banks have given. And our answers would be clear, I guess.
Yeah, it's interesting you say that, because you're technically a hedge fund, and people who stick to these retail banks, which are, as you said, boring, they are more like the long-term funds who churn their portfolio once in 5-10 years. One would expect that someone like you would be taking a little bit more risk and trying to buy that private bank, which has been beaten and bashed a lot because it's got a corporate exposure. But you don't think like that. You think that risk is not worth taking?
So if one is playing a revival, then it's better to play via a private, relatively better managed bank, no doubt about it. But we don't see, like, if you're a hedge fund, so you should not be doing one thing versus the other. Like if it's a hedge fund, stakes are higher, so you're more skin in the game, so you want to be being even more sure of what you're doing. So I guess we tend to hold stocks for a longer period, and we are happy to sit and wait for the value to crystallize. And look, at the end of the day, a book value of a bank would be growing, call it like 18 or 20%, and so far you're sure of that 18-20%. Who wants to leave that? Nobody, I guess. So do we.
What about housing finance? That's another area where you have interests in. Is that a long-term sustainable story in your eyes?
Yeah, it's done well, over the last 3-4 years. Again, all those investors who wanted to take, position in financials but were concerned about these mounting NPLs, quarter after quarter, housing finance was a good sort of area. I think, again, valuations are, a bit toppish there as well. But then, are we sort of, comfortable with the business model? Are we sort of comfortable with, the dynamics of housing in India? I think we are, to some extent. Real estate prices could be a bit of a challenge, but as you understand, these banks, are not lending a very high loan to value. So overall risk is managed, and therefore, again, are these stocks going to give me my 16 or 20% compounded book value growth? If yes, then we would like to stick.
You were saying that your India exposure is actually one of the largest in the emerging market that you operate in the basket. How do you justify that to your investors, where you see those powerful rallies playing out in Brazil and Russia because the way commodities moved in a short span of time? Do you get questions saying, why are we in such a defensive market like India, where we are not participating in this big 80%, 70% kind of EM rallies?
Well, yeah, look, 80% EM rallies coming after, a similar decline. So if you were in, sort of, you term it as a defensive emerging market, you are still better off point to point. I think that the issue with some of these commodity exporting emerging markets, Brazil, Russia, South Africa, etc., rallies are powerful and sharp, but then you need to have, that sort of a conviction that, look, if iron ore has gone up 70-80% from the lows, it will stay around here, or it will go up even higher. We are taking a view internally that we are not very comfortable playing this China capex theme, and therefore all the capex commodities, call it iron ore or copper, etc., we would not be very, comfortable taking a positive view on these commodities, and therefore, by definition, we would have to rule out certain sectors, stocks, markets. On the other hand, we view oil as an OPEX commodity, and it's interesting statistic that is probably one of the large commodities where China does not consume more than its fair share of global GDP contribution. So it's not like a very skewed sort of a demand profile for this commodity. We view it as a OPEX commodity, so we are happy to take a sort of a more constructive view on oil compared to rest of the commodities. So we will not sort of chase these sharp rallies in some of these markets, as you just mentioned.
But do you think oil has bottomed out?
Again, I mean, it's difficult, but look, I mean, one can sort of make a case that unlike an iron ore mine or a copper mine, where you set up a mine and it's going to produce for 20-30 years, till the time the reserve lasts, oil is a different sort of a commodity, where in a oil field you set up oil field, you start producing, but then you reach your peak production in 4 or 5 years, and then naturally you start declining production from that particular field by say 3 or 4 or 5% every year. So how do you replace that production is you have to drill more wells. And would you be drilling more wells when oil is 30? Answer is no. So a time will come when all the wells that are producing today would have peaked out and would have started to decline unless we start drilling more. So that makes you think that there's probably a bit more of a fundamental angle. I mean, look, there are many other aspects to it in the short term. What would OPEC do and not do, etc. But I mean, if I was to take a more fundamental view, then that's how I would look at it.